Hey everyone, today we're diving into a mind-blowing article from Seeking Alpha titled, "Oh boy, the entire stock market hinges on just 1% of stocks" by Leo Nelissen. If you've been watching the market soar, you might think everything's golden. But what if I told you it's all hanging by a thread? Stick around as we unpack this eye-opening analysis. Let's jump in. Alright, let's start with the big picture. The article kicks off by pointing out that the stock market looks super strong on the surface, but dig a little deeper, and you'll see it's driven by just 1% of stocks. That's right, a tiny fraction is carrying the whole show, creating a huge imbalance. According to the piece, over the past 10 years, the S&P 500, that's the SPY ETF, has returned a whopping plus 300%. And if you're in tech-heavy stuff like the Invesco QQQ Trust, or QQQ, you're looking at plus 508%. Using some basic high school math, the author calculates the compounded annual growth rate for the S&P 500 at about 14.9%. Impressive, huh? But here's the catch, this growth isn't spread out. It's concentrated in a small basket of stocks, meaning future returns could hinge entirely on those few winners while the broader market lags behind. Now, why does this matter? Leo Nelissen explains that this concentration creates both risks and opportunities. The market's strength is kind of superficial because it's so reliant on that 1%. Think of it like a frayed rope under pressure, ready to snap. The article even uses an image from iStock to illustrate that. A rope on the verge of breaking against a yellow background. If those top stocks stumble, the whole market could feel the pain. But on the flip side, the author sees a chance to pivot. He's planning to position his investments for a potential rotation into overlooked areas. The stocks that have been ignored while the big names hog the spotlight. Importantly, he's not going all in on something like an AI ETF. Instead, he's strategizing to balance the risks without missing out. Before we go further, a quick shout out to the author. Leo Nelissen is an analyst who focuses on major economic developments like supply chains, infrastructure, and commodities. He's a contributing author for iREIT plus HOYA Capital, where the team provides insightful analysis and actionable investment ideas, especially around dividend growth opportunities. If you're into that, the article links to more info. Check it out for deeper dives. Just to keep things transparent, like the article does, Leo discloses he has a beneficial long position in shares like TPL, FIX, LB, and CNQ through stocks, options, or derivatives. He wrote this based on his own opinions, no outside compensation, and no business ties to the companies mentioned. Remember, as Seeking Alpha notes, past performance isn't a guarantee of future results, and this isn't personalized investment advice. Always do your own research. So, to sum it up from the article, the stock market's fate is tied to just 1% of stocks, making it vulnerable but also full of potential for savvy investors. Leo's take? Get ready for that rotation into undervalued areas to hedge your bets. If this got you thinking about your portfolio, drop a comment below. Are you worried about market concentration, or do you see it as an opportunity? Hit that like button if you found this helpful, subscribe for more breakdowns like this, and turn on notifications so you don't miss out. Thanks for watching. See you in the next one.